Wallace, you ready to get started?
I am, absolutely.
Awesome. So thanks everybody for joining us. I'm very pleased today to have my good friend, Carey Wallace, join us talking about agency valuations and what are we thinking about the COVID-19 crisis and what kind of impact is that going to have on agency valuation. So first, Carey, welcome and thanks for being with us.
Yeah, thanks for having me. I always love conversations with you.
Yeah, we've had some good ones. Carey's one of my walking buddies when we go out on conferences. So we've had some nice long chats in the past. North Carolina yesterday hit the dubious mark of having its 1 millionth unemployment application filed, which represents about 20% of the eligible workforce. So what I'm thinking about right now is just what type of economic contraction there's going to be, and I'd love to hear your thoughts on what that's going to do to agency revenues, and then in turn, how's that going to impact valuations?
So I'm sad to tell you that Ohio hit that mark as well. So it is troubling how quickly unemployment has climbed. We went from record low to they're actually predicting that unemployment in Ohio by June will be 20%. Obviously, it's the highest it's been since the Great Depression. And we did a webinar where we looked at agencies over time, and we looked at the number of agencies through all kinds of epidemics as well as recessions. And what's really neat about the industry that we're in is the number of agencies remained fairly constant. In the last 14 years, it's only declined by 2%. And the multiples grew. It didn't matter that we were in a recession. The value of agencies remained high and grew significantly. And it's because the nature of independent agencies are that there are stable revenues, they are profitable, they're like annuities. So it's attracted it's attracted all kinds of private equity. What's unique about COVID is the depth and the breadth of what it's done to our economy so quickly and so rapidly that it can't not impact every part of our economy. So when I think about the impact that it's going to have, the question is, what I think about it is it depends. It really depends on where the revenue's coming from in an agency. Is it personal lines? Is it heavy commercial lines? Is it heavy in a niche? And it's really important for agents to take a really hard look. This is where data is no longer an option. You have to know the data in your agency in order to assess the risk and the impact that this could have. We actually are doing a scenario tomorrow on a webinar that walks through what a cash flow statement would look like and what the impact is from this, where we look at how will it impact a heavy personal lines agency, and what does that look like? If you think about it, right now if we had 20% unemployment, what is that going to do to our auto coverages? What is that going to do, and when is it going to happen? The first step, they're probably going to reduce their coverage. The second is they're going to stop paying. Then home is going to follow that. That's not going to be immediately, but what does that look and feel like? And it really depends on who you insure as well. If you insure someone like you and I, or someone who's closer to retirement, that risk is different than someone who's first starting out and might have lost their job, right? So it depends, but it's super important to look at the specifics in your agency and assess the risk and the impact that's coming.
Yeah, I know sometimes, looking at averages is not necessarily a great thing because, Bill Gates or Jeff Bezos walks into a conference, all of a sudden on average, everybody's a millionaire, right?
Right.
But I do want to think about averages a little bit. I mean, I've seen numbers that the average agency is expected to contract in premium maybe between 6 and 8%. I've talked to a few best practices agencies in North Carolina over the last week, and they've all scaled back their projections from being in that 8 to 10% growth range to flat to 2%. So is that consistent with what you're seeing and hearing?
Absolutely, yes. The other thing that I'm hearing is the phones aren't ringing. Like all new business is, shouldn't say all, typical new business is not the same. So not only is what your renewal is going to shrink, new business right now is hard to come by unless there's specific niches that you're focused on. And you know, I think I heard from one agency that they actually tracked their call volume. It had declined by 40%.
Yeah.
And so again, if you know that data, you're going to react and take action. So what does that mean in an agency? You know, number one, have a cash flow statement. Predict what you think is going to happen, both in personal lines and commercial lines. And commercial lines is a little bit more clear. I mean, if you insure restaurants, any kind of travel or
hospitality in general,
you know, any kind of tourism, if you're in manufacturing in the state of Ohio, if you're in farming, it is clear impact to that group of people because the prices are dropping, and you know that there's just major risk. Retail, if you have any of that, there's a huge impact. Then you can start saying, what's going to happen to this segment of my book? What's going to happen? And we are encouraging doing a best case, worst case, and most likely, and then watching it and making sure that your expenses are being adjusted at the same rate. You know, Aubie, the biggest expense in an agency is their people, obviously. Now more than ever, how you're compensating your people, it better be tied to your revenue, because if you are paying flat salaries across the entire agency and you don't have the flexibility to adjust, your profitability in your agency just changed, which drives the value of your agency, which drives all kinds of things. So having the right comp structure that is flexible and moves with your revenue is important. Yeah.
So let's talk about, you mentioned PE a little earlier, and I want to get into private equity conversation, but let's talk about the local agency that has sold to the slightly larger local agency. I want to talk about the agencies out there that might be carrying some debt right now, just because they've acquired a few people in their area. Yep. Are they going to be in trouble? I know it depends, right? I mean, it depends on what their cash flow situation was and how well they're managed and whatnot, and the cash that they purchased. Was it a commercial lines agency, personal lines agency? But just talking generally, what type of contraction do you think agencies are going to be able to withstand and still be able to service debt that they've picked up to make acquisitions over the last few years?
Yeah. So here's the thing. Agencies think about acquiring based on a multiple of revenue. I don't think that conversation is gone, because what you just said is important. When you buy an agency, you know that funding it is part of being able to have the revenue stream to support that. Now that's at risk because there's some unknowns. So now the debt that you took on, you don't know if you're going to be able to cover it or not. Number one, restructure your debt. There's small business loans available everywhere right now. So if I was in that situation, I would make sure I restructure and get my rates as low as possible. And then I would do the same assessment. I want to know what my revenue streams are. We value agencies, and I know that agency owners do not go super deep into that book to think about what that renewal is going to be. They count on the fact that renewals are going to run at 90% or higher in any agency. That's what you typically see. That's the average across the country. In really well-run agencies, they're 94, 95, 96%. So, that wasn't a thought until now when you have this massive change in our economy. I would restructure immediately. I would absolutely assess the risk in my own book, in the new book, and I'd try to shore it up as quickly as possible. I would be reaching out to every insured to make sure that they understand who we are, because you and I both know we got a lot of time on our hands as people who are insured. And when people have time on their hands, they shop. They think of, how do I reduce my costs?
Yeah, I read yesterday that there was an estimate that 60% of personal lines consumers would be shopping their insurance, but because of this. I mean, one, they're watching way too much television right now, so every other ad you see is how we can save you money on your auto insurance, right? but they want to be.
Netflix and Hulu where those aren't. I'm just kidding.
Yeah, that's right. That's right. But it really, I think that's a tremendous opportunity for those agencies that have done a really good job marketing. So, because if 60% of your customers are going to be shopping their account,
right,
it also means that 60% of your competitors' customers are
Yep.
going to be shopping their account. Well, if your phone's not ringing with people shopping, you've probably had a marketing failure right now, and it's a really bad time to have had a marketing failure.
Yeah, and I would tell you, Aubie, what all of us want to do right now is to help people that are local. Yeah, I can tell you at least 5 local businesses that I want to see succeed. So I will go out of my way to help them. Independent agents are local. They should be talking about that local, being ingrained in that community. Those are people who like and trust and you want to do business with. So there is an opportunity in the right way to reach out and say, hey, listen, if you want to shop, we can absolutely get you covered because we're here, we're in your community, we're with you. So I think that there's an opportunity to be very, very strategic with how you communicate to your current clients as well as to all clients and about your agency, that you care about your community.
Yeah, I completely agree. Let's go back and talk about the retention rates and how they're likely going to suffer just due to overall general economic conditions. How is that going to affect the earnout of those agencies that have sold to PE over the last couple of years and they're still in that earnout phase? How do you see the values of those agencies dropping really post-agreement?
Yeah. So the whole point of an earnout is to share in the risk. So if an agency declines in value, both people lose. Even in an internal, I know you're talking about PE, but even in an internal, when you do a buy sell with someone, the whole idea is you stay on for a period of time in order to transition those key accounts to make sure that retention stays where they're going to have revenue to support and be successful going forward. If those key accounts, let's say, you were heavy in restaurants or you were heavy in oil and gas, you're an agency in Texas, everybody loses in that situation. There is no revenue to support that, and that declines in both situations. So, unless you wrote a buy-sell agreement that says I'm going to pay this amount no matter what, but then you're at risk of putting that agency in real financial hardship and not setting them up for success. So, I don't see any way that this doesn't impact those earnout agreements. It's certainly not the buy-sells that I see in the agencies that we help.
Yeah, so the past few years, it's really been such a seller's market. I mean, there have been so many potential suitors out there that want to buy independent agencies, whether it's banks, whether it's PE, whether it's the local independent agent who wants to grow. I think to some extent that has caused some agencies really not to plan as maybe as well as perhaps they should have, because they've just kind of thought, well, whenever I get ready to sell, I'll just be able to return one of these phone calls that are being left for me every day, right? I mean, I don't have to. What are your thoughts on what the marketplace is? How is the marketplace going to shift now? Is this going to become more of a buyer's market? Are there going to be fewer buyers? How do you see this transitioning?
So I still see agencies as incredibly profitable and great investments. There's just no two ways around that. But I think that there will be much greater scrutiny on what you're buying. I said it before, and I believe this. When an agency tells me, well, I just want to get 1.5 or 2 times revenue, that measurement on what you're buying, either as a buyer or a seller, is incredibly risky. Now more than ever, we know that that's risky. So I think the nature of the scrutiny will change. I think the risk factors in an agency have been highlighted in a major way. The agencies that are successful today in this pandemic are the ones that were easily able to move to being technology driven. They were able to go to remote very quickly. They are not paper-based agencies. They are using an agency management system. All of those things that we know now became incredibly important, right? So I think those that have those will maintain their value, but those that do not, that are paper driven, that value is very different because you can't assess the risk in that book as easily as you can in one that uses an agency management system, has dashboards, has a handle on what they understand about their book, is completely different. So I definitely think the scrutiny will be different. I think that the value that you place on an agency that you understand what you're buying will be different. But I also think, PE might not be as prevalent in our marketplace right now, and that will change the multiples. And this really depends on how long this persists and for how severe this is. But again, I think the investment is still really, really strong. I mean, agencies are profitable, and I don't think the renewal rate's going to drop so much that it's not going to be viewed like an annuity. But I do believe that it will be significantly different. If you waited and you thought, I can do this at any time and I can get 7 times EBITDA in order to get this, I don't know, Aubie. I think that agencies that are in acquisition mode are going to be a little leery. They're going to hoard cash for a little bit, ride this out, understand the impact to their own agency, and be able to assess what an agency is that they're purchasing. So I don't know that you're going to get 15 calls a week about your agency at this exact moment, which is what we would have said 5-8 weeks ago.
Did you see the article? I saw an article, I think it was late last week, about the savings rate in the U.S.
I did not, no.
Yeah, so the overall consumer saving rate was the highest since 1981. So it just made me think of that when you mentioned hoarding cash.
Yeah.
Apparently, a lot of people are in the mindset of hoarding cash right now. And so I can't remember, we'll have to go back and look, but if you're interested in that, there was an article that the U.S. savings rate for April was the highest since early in the Reagan years, and that the U.S. citizens saved a couple of $1 trillion put away in the bank in savings last month.
Yeah, when there's uncertainty around us, we don't spend money. We are, and it makes sense. Like, you don't know what's going to be in the next 60 days and 30 days,
right,
whatever it is. So same things for businesses. They don't know.
Cash is king, right?
Impact. Yeah, right.
Yeah, cash is king. Hey, so you hear a lot about the possibility of this being like a V, right? Like it's an immediate, like the economy just fell off a cliff and hopefully it's going to come back up like a V shape. How do you have any thoughts on what the time period of that kind of needs to happen in order to stabilize the agency marketplace in terms of valuations and the buying selling climate?
Yeah, so I have a little bit of thought about that. So small businesses in general, I read a report that looked at about 12 different segments of small businesses, and they looked at their cash flow. The average small business only has 27 days cash on hand. So they're estimating that about 20% of small businesses across the country are going to close, and that's about 1.2 million businesses. So every day that this persists, that number gets higher and higher and higher. So restaurants in Ohio, there's 47% that have said that they think they're not going to open again. They're just not.
47% think they're done.
They're done.
We won't survive this.
And
even with payroll protection plan,
That's correct. The reason that they say that is because the normal that they're going to be reopen, they can't operate in a profitable way. So I believe that this has changed some of our cultural behaviors about our own safety, around our health. I don't know that we're going to be real comfortable standing shoulder to shoulder with people we don't know, or eating shoulder to shoulder with people that we don't know in any time soon. Like even when restaurants open, I don't know that people are going to flood the gates and go in and have a meal, right?
Well, yeah, as you know, I spent a lot of time in Georgia, and Georgia's received a lot of criticism for, quote, reopening too soon, but they're reopening exactly like what you're talking about at 20% capacity. Well,
right.
I know a number of restaurant owners, they're saying, it doesn't make any sense for me to open at 20% capacity. I'll lose more money being open and serving 20% than I will just staying closed.
Right.
Because of labor costs and everything else.
The hotels are the same way. They're saying they're at 20% capacity, and they expect by the end of the year they might raised to 40% capacity. That's what they think their best case is given this situation. So, what would it take to rebound? I think it depends on the industry, Aubie. I think that can you accommodate how we're going to behave differently? 9/11 changed us with security. I think this changes us with health, and it changes what we're willing to accept, what standards we have in order to make sure that the people we love stay safe. So I don't know. I think that it depends on the industry what the rebound could look like, but it's not across the board, and it's certainly not we're all going to go back to the way we were. Remote work. There are plenty of people. We are in the relationship business. I want to be around people. I live it. I breathe it. Independent agents that I know want to be face to face. And here's the thing: we've been able to operate without being face to face, and now we have all these buildings that have all this space that we all insure. And what's going to happen to those buildings? What's going to happen to, the commuting and the use of the cars? And there's a ripple effect that's going to happen from this. So I don't know that anyone can answer that question, but I think if you look by segment and start assessing the risk there, that's how I would prepare as a business owner. What are the things that I think can rebound, and what are the ones that I think might never go back to what they are?
So let's talk about that, because I think that's actually a great segue into what I wanted to ask about next, which is if you're an agency owner and you are contemplating some type of ownership transition, whether that's internal or an external sale, what are some things that you should be doing right now to be enhancing the value of your agency? You've mentioned technology, right? You mentioned making those investments in technology, being able to accommodate different work styles and being paperless and those types of things. What are some of the other tips that you would have for agencies that really want to enhance their values or increase revenues right now?
So the number one thing that I would tell an agency owner to do is study your book, really, really understand what it is, and create a cash flow statement. Number one. Number two, reduce your expenses wherever you possibly can, and make sure that the expenses you have are driving whatever growth opportunities that you have. So meaning if you're running a lifestyle agency right now, you should be really thinking about removing those lifestyle expenses in your agency and getting as lean as possible. That's the best way I know how to say this, but we evaluate and do a fair market valuation for plenty of agencies, and they are profitable organizations, and they can still run a profit and have lifestyle type expenses in their P&L. I think this will force making some decisions in order to get your profitability where it should be, and getting really serious about where do I want to put those funds to invest in marketing, to invest in technology, to invest in efficiency, to invest in maybe the people that I need to in order to take it into the future. So the third thing, I would check your compensation plans, and I would get really serious about those and tying them to growth and retention, and the overall growth of revenue in your agency. Because if you pay on growth and you're losing out the back door, it has to be the total growth of your agency that those comp plans are written around. So it needs to match that, and 100% file for assistance. If you haven't filed for assistance in an agency today, and it's because you don't think your cash flow is going to be impacted, I would tell you to do it so you have the resources if that occurs in your agency. I want to see our agencies flourish, and I want them to have all the resources they absolutely need. So I would highly encourage them to do that. And then I'd identify areas of growth. We were talking earlier, there are areas that are growing. There are, someone who insures FedEx right now is not doing poorly. If someone who has anything that's delivery to your home, anything that we are utilizing right now, anyone who has technology companies that they insure, all of those things are doing well. So find the areas of growth that make sense that you have in your own book and grow those areas and focus on those. And make sure that you're talking about who you are as an agency. now is not the time to be quiet. Now is the time to be talking about, you're in this community, you're here for them. It's what you do. You have relationships, you need to just talk about it. So those are and the other thing is, I would build the strongest balance sheet I could. I would make sure that I restructured my debt. I wouldn't pay down my debt, but
you too would hoard cash.
I would hoard cash without question. But I'm a financial person, so I would be conservative as a business owner in this uncertainty. I wouldn't pay down my debt. I would restructure it, and then I would get very disciplined and make sure every dollar I'm spending is driving growth. And if it's not, why am I spending it? Renegotiate your contracts. Whatever you can do to reduce your expenses and give yourself some room is what I would do.
Great. One area that I think agencies can benefit from focusing on right now is actually life insurance too. There are a lot of people that, anytime you have some kind of a disaster or catastrophe that where every night when you turn on the news or you open up Twitter or you get on Facebook, the first thing that hits you in the face is how many people have died from COVID. Yeah. It starts to cause people to think about their own mortality and, do I have enough life insurance, and those types of things too. So I think there's an opportunity for agencies as well.
Absolutely agree with you, 100%. I would say that would probably be an area of growth that people are thinking about, they're interested in. It's not a difficult leap at all. So 100%, yeah.
Right. When you talk about lifestyle agencies, can you give me some of the more common thing? Are we talking about where we run the spouse's car through the agency as an expense?
So typically there's multiple, maybe golf memberships, there's multiple cars, there's multiple, sometimes you own the building and the rent that you pay to yourself might be inflated and not necessarily what market rate would be. There's many different things that occur in an agency, but the most common are what would be personal expenses like cars for every single family member that's in that agency, whether that's a huge expense, and multiple memberships to organizations that doesn't work. Some is they've made donations to things that may or may not drive business. That's a little bit different because that's really supporting your community. But I would say cars, memberships, unrelated to the business that really don't impact whether or not you can drive growth, those would have to be removed.
And once you remove those items, EBITDA improves.
Oh, for sure.
And that improves the valuation of the agency.
So, I'm glad you said that, Aubie. When we do a fair market valuation of an agency, it's really, the conversation is about what's your value, but it's really about what drives us to get to that value. So we take an agency's financials. We use industry standards to tell that agency, this is what a profitable agency looks like. These are the amounts that you should be paying for compensation. This is what you do for selling expense. This is what you should do for operating expense. This is what your marketing expense should look like. And then we talk about all the adjustments up or down that we made in order to get them to pro forma. That's where most of the conversation is. And that's really about, if you want to run a profitable agency, this is what it should look and feel like. Why are you different? And are there opportunities for you to run it differently? Some, it is, it's a decision that they're making, and that's totally fine. But it's about informing what a profitable agency would look like, and then what's the risk in the agency. You take that EBITDA, you multiply it by the multiple is defined by the risk factors that we identify, and those move up or down based on the amount of risk in your agency, what your carrier mix is, what your product mix is. Are you concentrated in one area with a carrier, with a niche, with a producer? Do you have a plan? Do you not have a plan? Again, all about risk determines that multiplier of that EBITDA. So if you can make that EBITDA larger and you have a higher multiple, your value goes up. And so, running a profitable agency first and foremost is the core, and then working on all the risk. And when I say lifestyle, those are the least profitable because there's so many expenses that can't be supported in order to drive that profitability.
I did get a text message from one of our listeners that said we need to ease up here. We've gone to meddling.
Sorry about that.
Yeah, me too, but not really. All right.
Anyway, I mean, it's just something to think about. There are opportunities to run your business differently.
When so risk factors, you kind of started briefly naming what some of those are, and what you're looking for is areas of concentration, like where you're too concentrated by carrier or by producer.
Yep.
What anything else really speak to risk factor?
The biggest risk factor in any agency is having one owner past the age of retirement with no plan, because that means if one single event happens to that person, there is no plan and it'll be sold at a discount very, very quickly if someone's not prepared to do that. So that's the number one risk factor. The second is no growth in the agency. That's what makes it super attractive. So there's no profitability and no growth, there's nothing to multiply. So you have to have those things. And then who's driving, where are those relationships? So who has the relationships with your clients, and is there any one large client? That's incredibly risky in an agency, to have, more than 15% of your revenue in one client or one area. One niche is also very, very scary. And, COVID taught us that pretty clearly, but you think about it, the oil and gas is the one that every single time I think about, our friend Josh, who was on the phone with us, having, I think he said 40% of his agency is in oil and gas right now. I mean, that's incredible. So having any kind of concentration like that, or in any one carrier, if they change comp structure and you've got 70% of your book with one carrier, or even 60% of your book with one carrier, you really put a lot at risk that could change the course of your agency. So the goal is to not have any more than 25% with one of your carriers. And this varies based on the size of the agency. So just take it that I'm talking in general, and these move and shift based on the total revenue, but 25% with your top carriers, and then make sure that you're maximizing your top 3 to 4 carriers as best you possibly can. So, that should be is moved, spread out as possible. And then who are the relationships with your clients? You don't want one producer having all top 10 accounts in your agency, because again, if something happens to that person, they own all of those relationships. Will they stay with your agency if they leave, if they become, not able to work, whatever that is? So do you have a rounded approach to your client relationships, that those are easily transferable if something would happen? Again, it's all about concentration.
Yeah, it's so interesting in that, we went through with the Great Recession in 07 and 08, and I think agencies that were concentrated in residential home builders, for instance, I mean, they got clobbered. Agencies that were in transportation got really clobbered as well. But now, I mean, I think we've probably mentioned at least half a dozen different industries right now, whether it's oil and gas or hospitality, restaurants. I mean,
right.
It's across the board. There's so many more people getting clobbered through this event than there have been.
There really are. And it's tough to get your arms around, because you said earlier, the length for which this persists causes the ability to bounce back from it to be harder and harder and harder, or just to be able to quantify what we think the impact will be. So, yeah, it's tricky.
Yeah, absolutely. Well, how many transactions have taken place on average over the last 3 years, Carey? I mean, it's been a mind-boggling kind of number between agencies, and have those ground to a halt. You mentioned, and which by the way, I agree, when my conversations with some North Carolina best practices agencies this week, they all related the same topic, which was our new business pipeline, like the things that we had in the pipeline are all coming to fruition now, right? I mean, we've either sold them or we didn't.
Right.
And the pipeline is not full now, right? I mean, going out and establishing a new relationship in this environment is not happening.
Right.
So like the pipeline is dry and new business is ground to a halt. Is the M&A activity going to just temporarily grind to a complete halt until we have a little more certainty about some of the things that you and I are talking about what the premium contraction is going to be and how fast the recovery is going to be and those types of things?
Everything that I've read, Aubie, has told me that it's going to slow. And I don't know about grinding to a halt, but it's definitely going to slow. And I think that it will not be as prevalent. I mean, you asked me about activity. So in the last 18 months in Ohio, I know our numbers inside out, backwards and forwards. I think that we had 127 transactions, and 91% of those were retail agent to retail agent. That was one agency buying another agency. I don't think that that is going to completely go away. But again, are you going to be quick to take on debt? Are you going to be quick to take on the unknown when you have unknown in your own agency? I think it'll slow. I think that, but grinding to a halt, we are in an incredible industry, and it is one of the best investments you can ever make as an independent agent. I believe that to my core. I believe that it's changed a bit, but that fact is not different. So find me another investment where you have 80% retention of everything. Like, just find me that. That doesn't exist. So we go from 90 to 80. It's still a great, great investment. So I don't want to be completely doom and gloom here, but I want to say that the game has changed, and doing this without a plan and without being thoughtful about it is no longer what I would advise someone to do. I think knowing your value and knowing what's driving that value is incredibly important. And if you want to transition, you should be working on increasing that value as best as you possibly can. You should not wait to sell your agency to start running it well and showing that profitability, because when you do that 2 years prior or 3 years prior, you're going to get much more for your agency than if you did not. So I don't think dry up is the right word. I think slow and thoughtful is what I would tell you. I think it will become.
All right. So let's talk about data a little bit, and
Okay.
and certainly we're business partners with Intellagents, and tell me about how agency owners can really start using data to better understand their business and to gain some of the insights. Is that going to help them maybe identify some of these risk factors that you're talking about so that they can take corrective action now and lower that risk factor so that they're getting a better multiple when it is time to sell?
So I think agency owners right now, the best people you can learn from are other agencies that are profitable, that are growing, that are incredible, that have high multiples and high values. So the best thing you can do is look at how you compare, and then again, use these industry benchmarks in order to find out, where am I different and why is that, and what business decisions can I make to improve? For instance, I have a certain carrier mix. I have my own carrier strategy. I have my own product strategy. And I now learn that I, on average, make 2 points less than an agency of the like size. Why is that? It could be many things, Aubie. It could be that I'm part of a network, alliance, or cluster that I give up a point or two. It could be that I'm writing smaller business. It could be that I'm in a niche that isn't as profitable. It could be that I've maybe chosen the wrong carrier partners, and there's some opportunity there for me. The whole idea is look and see where you're outside of what the standards may be, and decide, do I want to be outside the standard? And I'm actually setting the standard, so I don't want to do anything, but have it as a barometer so you can start making decisions in your own agency. Productivity numbers are probably at the top of the list that I would want to know as an agency. So what should I be expecting my producers to be doing, or my total staff to be able to handle? And how does it compare to an agency just like mine with the same kind of premium volume in my marketplace, which is super key. I don't want to be compared to agencies in North Carolina when I'm in Ohio. You guys are coastal, you have different premiums, you have different workers' comp environment, we can't compare. But I can certainly compare in my own marketplace, and I can start asking questions of, maybe I'm overworking my people, or maybe I'm not expecting enough from them. And now I can really start to build out what my team should look like. So there's many, many things. And the best way is to learn from other agencies that are getting those growth rates. So, we have a report that shows you those agencies that are growing through acquisition, those that are growing through, organically, and how you compare. And we show you what's their staff size looks like, what's your staff size looks like, what is their product mix, your product mix. Those are incredibly valuable things to know, because you just don't know as an agency owner without it.
As a rule of thumb, what do agencies need to look at from a payroll and compensation as a percentage of revenue? What do you think is a right benchmark there for medium-sized agency?
Yep. So an agency that's 1.5 million to 2.5 million, your payroll should be around 44%, and total compensation should be about 52%. So really across the board, payroll and benefits should be somewhere between 50 and 58% of your agency. When you get, and that's total. So that means owner, producer, support staff, all of that should be in that range. And it really does change based on the size of the agency, but it should be roughly half of your revenue.
Roughly half. Right.
Yeah. Yep.
Cool.
You got it.
Yeah. Well, we've got about 15 more minutes. I don't see any questions. Adam, have I missed anything?
You must have scared him away with that lifestyle conversation.
Yeah, I only got in. All right. Well, happy to open it up for questions for a little while. Carey, if there's any final comments or thoughts that you have.
I just think now is the best time to think about what data you know about your own agency, how well you know your book, how easy is it for you to get in touch with your clients, and if it isn't, that's something you should be focused on, because I believe that the agency of the future is the ones that can marry their relationships, which differentiate them, no doubt, with the data and the technology. And without those three, someone else will be able to get to your clients. Gone are the days as it's just, I need to protect my X date. I need to protect my agents, and I need to protect my customers and really predict what they need from me and be there for them. And the best way to do that is to understand them. So I think now is the best time for an agency to be thinking about, what could I learn about my customers and how do I use it to be predictive rather than reactive? Yeah,
great advice. I certainly agree with that, and think that we're just starting to scratch the surface on how agencies can use data to better understand their clients, better understand their agencies, and make better decisions.
Sure are.
Yeah. Hey, Carey, thank you so much for being with us. Greatly appreciate your time and your friendship and your partnership. So thank you very
thanks
much.
for having me. I appreciate it, Aubie.
Yeah, absolutely. We'll be sure to send you the link so you can share this with whomever you want. Okay. Thanks to our partners for their support of IIANC throughout the year. You can see them going on the slides now. Amwins and RPS and Swiss Re, our chairman circle, along with Travelers. And then our presidential partners, AAA of the Carolinas, Heritage Insurance, Johnson & Johnson, JSA, Liberty Mutual, and National General. So thanks to all our partners. And then next week, we'll have 4 people on Town Hall Tuesday that you will want to hear from. These are the 4 IIANC members that are part of the North Carolina legislature. As you will probably know, the North Carolina legislature is in session right now. And they are deliberating COVID-19 response specific legislation. They'll be back later in the year to look at some regular legislative agenda items. But this week, they're contemplating a package of COVID-19 relief efforts on a state basis. And I'm sure you'll want to hear from them next week. So be here at 1 o'clock, and we'll talk about those issues. So thanks everybody for being here. Carey, thanks again. perfect timing is the guy with the leaf blower just made his way around to my side of the building now. So we're going to end just in time. Thanks, everybody. Have a great day. Bye-bye.
Have a good day, Aubie.
Bye-bye. Thanks, Carey.